Are we heading back into the depths of the pandemic? The Netherlands enters lockdown, the city of Amsterdam deserted, New York is preparing for a massive surge in cases, European borders begin to close for UK travellers as Britain gets slapped with a high-risk virus variant area classification. A new variant named Omicron is rapidly spreading around the world, causing chaos amongst investors as global equity markets become more volatile. But is this just another case of classic market overreaction due to the heightened media attention, which has sent the fear and greed index into extreme fear territory? Well, whilst it's up for debate whether this new variant could indeed be anywhere near as deadly as the Delta variant, the latest figures certainly show that this looks like to be one of the more milder variants that we've actually seen so far. So what's all the unrest about in the financial markets? It certainly appears to be a case of investor confidence declining as a result of fears around this kind of new variant called Omicron and all of the kind of impacts that that could have all around the world, amongst other macroeconomic conditions as well, in which we're currently facing into. Now, of course, this new variant throws around the possibility of global lockdowns, restricted international travel, along with supply chain issues just as things started to get better. We were all well, most of us anyway, certainly 2 vaccines forward, only to kind of now be on the cusp of taking one big step back as appears to be hitting the fan once again. Emergency meetings are taking place in Westminster to decide whether we're going to go with a plan A, B or C over the Christmas period, but as of right now it certainly looks like Boris Johnson doesn't have a Scooby-Doo what he's doing. The important point to make here is that if this Omicron variant has the same kind of impact that we saw back in, I guess, kind of March of 2020 and beyond, then we could certainly be facing into a bit of a storm ahead in the stock market. In the very worst case scenario, do I believe we'll see the same kind of 30 to 35% market crash? Well, in my opinion, I certainly don't think we will. The market has dealt with all of this once before. It's no longer a black swan event. It's no longer a complete unknown. And due to that, I think investors can certainly take confidence in the fact that the market has already dealt with this once before. And because of that, I don't believe that we'll see the market value of all of the big companies all around the world absolutely destroyed like we saw in March of 2020. In actual fact, the pandemic has been pretty good for the stock market in general. And that's largely been driven by big tech companies who have seen huge accelerated growth and adoption of new technology as we kind of change the way in which we live our lives, from kind of working from home and just generally how we live on a day-by-day basis. So with that in mind, what could we be possibly facing into? Could it just be a simple market correction of about 10%, which, don't get me wrong guys, will certainly feel painful in the moment? Or could it be something a little bit more sinister? Could we be heading into a bear market where we see global equity markets sell off 20% or more? Well, there are a couple of factors which I'm very much paying close attention to give me a bit of an early insight as to the overall momentum within the stock market and how it could potentially go in the short term. So the first indicator in which I am looking at is both the 50-day and the 200-day moving average for the S&P 500. The reason being, a cross of these two technical indicators is also known as a death cross. Now, the death cross is a technical charting pattern indicating the potential for a major market sell-off, and with it being a reliable indicator which has forecasted market crashes in the past, like the 1929 Wall Street crash, the major recession of 1939, the oil-driven market crash of 1974, and as well the financial crisis of 2008. And the reason why I'm raising this today is because the S&P 500 is now trading in and around the daily 50 moving average, and we've actually seen a bit of a crossover down on the lower time frames. So let me share with you guys the chart in a little bit more detail. So up on screen you guys can see the S&P 500 on the daily time frame, this lovely upward trending chart, and as a result of which we've seen the two exponential moving averages in the 50 EMA, which is the green line, and the 200 EMA, which is the yellow line, has certainly been following the overall upward trend of the S&P 500. However, most critically, over the course of the past couple of days or so, we've started to see momentum in and around that daily 50 EMA, with actually, as of the 20th of December, a break below the daily 50 EMA before today's market prices actually heading higher once again. The break back below this kind of daily 50 EMA and very much testing it as an area of dynamic support in the market certainly suggests that we could very much be in for a little bit more downward pressure to come. As you guys can see, over the course of the past 12 months or so, you can see we've only ever seen a daily break back below this 50 EMA 1, 2, 3, and on the 4th occasion just back in March. So you can see it's a pretty critical area for the market to actually break below that daily 50 EMA. Now, of course, over the course of the past 3 times that this happened in the past, price then quickly went back up on to make all-time highs, and we saw another new high made within the market. However, could this time be different? Well, it very much remains to be seen. But as of today's current market prices, it looks like that this could potentially be short-lived and further upside could come. Nonetheless, for me personally, it's very much an area to very much pay close attention to, because if we do see a break back below that key 50 EMA level, then it certainly does suggest that a hell of a lot more downward pressure could certainly come in the market. Now, of course, the kind of death cross which I refer to, obviously we're nowhere near that kind of crossover between the daily 50 moving average and the 200-day moving average. The reason being, as of right now, we simply don't have enough downward pressure in the market to see that crossover take place. These kind of EMAs are a reflection of the average market prices for their specified period. So for example, the 50-day moving average is simply a correlation or an average of the past 50 days worth of price action within the market. And you can see the last time that this big crossover happened was in fact the March 2020 market crash, as you guys can see. However, what I did want to call out is over on the lower time frames, that crossover looks like it's occurring again. And whilst this crossover may just be short-lived and market prices may very quickly recover, it's also perfectly possible that this could very much be early signs of further downward pressure in the market, perhaps resulting in a market correction of 10% or more. So that very much is the first market indicators in which I look at from more of a technical standpoint, if you like, but do bear in mind these are backwards looking indicators based on lagging data within the market, and because of that, whilst they kind of do give us a little bit of an insight into the overall momentum within the market, they're obviously not definitive in terms of where the stock market could go in the very near future. The second major indicator, which for me is probably the most dangerous thing in which we're facing into right now, not from just a stock market and an investor standpoint, from just an economic standpoint more broadly, and that indicator is inflation. I feel like I've spoken quite in depth about inflation over the course of probably the past couple of videos, so I'll try and keep it a little bit more light touch. But in a nutshell, for those of you guys who haven't been paying much attention to any of my previous videos, well, be sure to go and check those out. But for those of you guys who haven't, in a nutshell, UK inflation is at 10-year highs at 5.1%, and it's even worse over in the United States. This means for every £10 sat in your bank account right now, you have essentially lost 51 pence in purchasing power due to the current rates of inflation over the course of the past 12 months. So aside from the fact that your money's being eroded by inflation, what's the actual problem here and how is it going to affect your investments and your investment portfolio? Well, the main issue is simply due to such high levels of inflation. The Bank of England quite surprisingly have reacted quite quickly to this, actually going on to increase interest rates from 0.1% to 0.25% just over the course of the past week. And the reason why so many people are surprised at this move from the Bank of England is because the likes of Jerome Powell, who is the chair of the Federal Reserve over in the United States, have called inflation transitory, which means in simple terms, inflation isn't here to stay. It will just be a kind of short-term increase in prices, and over time those prices will come back down to more of a happy medium where there's a bit more of an equilibrium between supply and demand. But to be honest, I think the average consumer out there can certainly call bullshit on this, because once prices go up, they never tend to come back down. So going back to my point, how does this issue actually affect your investments? Well, the period of expansion led by bond purchasing by the Bank of England, which is now up to £900 billion, looks like it's coming to an end. And due to the rise in interest rates, it now looks like the Bank of England have flipped the monetary policy script, as it now looks like we're heading into a period of potential contractionary monetary policy over here in the UK. By definition, with interest rates going up, people will be borrowing less money and therefore spending less money, and therefore the velocity of money throughout the UK economy will certainly slow down. And combined with the fact we're still very much in a pandemic and all of the operational challenges that come with that, the UK could certainly be back in a recession in absolutely no time at all. And if that happens, the Bank of England as well as the Federal Reserve over in the United States will need to be very, very careful on what they do with their current monetary policy and kind of balance that out with economic conditions, because if they don't, the arse could simply fall out of the stock market. So as the questions rightfully begin to arise as to whether the stock market will crash in 2022, how can we prepare our investment portfolios to weather the storm in which we're possibly facing into? Well, I think for me personally, there are predominantly two things that I'll be looking to do throughout the course of 2022 in order to protect my investment portfolio, but also grow it over the year as well. The first one being making use of diversified funds as a hedge against cyclical uncertainty. At the end of the day, guys, I'm certainly forecasting that value stocks will be the favored play for investors over the course of at least the next 6 months. And to be honest, I think growth stocks will get absolutely shattered. shafted. Similarly, I think financials, healthcare, as well as consumer staples could certainly perform better, whereas big tech on the other hand, possibly not so much. Due to this, one of the easiest ways to get that hedge against the cyclical uncertainty within the market is to invest in something like the Vanguard S&P 500 ETF, which just simply captures all of the top 500 companies in the United States of America. You get exposure to all different kinds of sectors and stocks, from Apple to Microsoft to JP Morgan to Home Depot, Johnson & Johnson and Bank of America. This allows you to stay fully diversified and possibly protect you from kind of big swings in the value of your investment portfolio. The final thing being is just to be decisive with your investment decisions. My trading 2-on-2 investment portfolio is down over £2,000 just in the past month. That's close to a 10% fluctuation in the value of my portfolio in a very short period of time. And this is where I think it's important to kind of check in with yourself and kind of make sure that you're still comfortable with the investments in which you've made, as well as your own risk appetite, and make sure that it still aligns with your overall investment objectives. Now, what I mean by that for me personally, when the market's on its way down, that's actually the best opportunity to invest into the market, as opposed to kind of waiting for the dust to settle and wait for the markets to actually recover. And if you're able to do that successfully, you should be able to capitalize on when stocks are actually at their most discounted prices. So that's going to be my approach, but if you do want to learn more about how to actually invest into the stock market during a market crash, then be sure to click on this video here. And if you did enjoy the video, guys, be sure to drop a like on it, subscribe to the channel if you're new around here. With that being said, I'll see you over in the next video.